So we're going to take a look at Valvoline today. And what we're going to do is value the company using a discounted cash flow model. And the way we do that is we enter financial information from Yahoo Finance. Then we're going to estimate the future free cash flows of the company. And we're going to discount those cash flows back to today's dollars. And then we'll have an intrinsic stock price that we can compare to the actual stock price to see if the stock is a buy or sell. We'll also look at financial ratios and compare those ratios to similar companies. So Valvoline is a manufacturer of automotive oil. They're located in Lexington, Kentucky. That's their headquarters, but they're all over the U.S. They have 7,900 employees, and they were founded way back in 1866. So to get started with the model, let's get the market cap, which is $3.74 billion. And then the stock price is 20.22. So now we know the market, we know the shares outstanding because it's the market cap 3.74 billion divided by 20.22, which equals 185 million shares. And we need that because when we estimate the value of the company, we have to divide it by the shares outstanding. So let's get the free cash flows in Yahoo Finance. We'll go to the cash flow section. And we'll pull the numbers. It looks like they have one negative in there. And then free cash flows is operating cash flows minus capital expenditures. So if you see a positive free cash flow in a given year, that means the company's adding value to its investors and it's improving its balance sheet. And if you see a negative, that means it's detracting value from the company and losing money off the balance sheet. So obviously you want a positive. So we'll go to the income statement, pull the net income, and that's the profit and loss for a given year. And you could have, as you can see, 2017, positive net income and negative free cash flow. For example, when you make one-time purchases like big purchases, that could really deplete your cash, but not really affect your net income. So to give you an example, if you purchase an office building for $1 million in cash, cash will go down $1 million, but your profits won't change at all. So in this year, 2017, they might have purchased a lot of expensive equipment, and that doesn't really affect the net income, but the cash goes down dramatically. So that's why we predict future cash flows when doing the discounted cash flow model. That's the best indicator of the financial health of a company. We need to know the capital structure of Valvoline so we know what to discount the future cash flows by. So they pay $73 million interest on its debt. Let's see how much debt they have. Current debt is only $15 million. So it must be all in long-term debt. $1.3 billion in long-term debt. So they pay 5.44% interest on the debt, and that interest is tax deductible. So let's get their effective tax rate. And we could just go back to the income statement and get the income before tax, and then get the income taxes, and that will give us the effective tax rate, 22%. So the cost of debt is only 4.3%. And it looks like they have 26% of the capital structures in debt. Now let's look at the beta. That's the volatility of the stock. And the beta is 1.5. So the stock moves 1.5 times the market here. And we have to combine the cost of equity and the cost of debt in order to get the discount rate. And the cost of equity, we used a capital asset pricing model to figure that out. And that comes out to 14%. And the cost of debt comes out to 4%. So equity is a lot more expensive than debt because equity is riskier. In the event of a default, equity holders get paid after debt holders. So when you combine these two numbers, the cost of equity and cost of debt, you get a weighted average cost of capital of 11.3%. And that's a discount we're going to apply to the future cash flows. So we estimated 4 years of future cash flows from our inputs from earlier. And we did a terminal value, which is all years past year 4. And we used a Gordon growth model for that. Then we discounted those numbers back to today, and we get a value of the company of $2.7 billion. And when we divide that by 185 million shares, we get an intrinsic stock price of $15. It's trading at $20, so it's trading at a 36% premium. So it's a sell according to the model. And let's see if it was trading at, it looks like it was trading around below 15, like as low as maybe $12 or $12.50 at one point. But then it's come up. And just to explain further, stock prices are not based off of how a company is doing financially. Stock prices are based off of supply and demand of the market. When more and more people want to sell a stock, the price goes down. It gets pushed down further and further. And when more people want to buy a stock, the price gets pushed up higher and higher. And the reason the market's been going up because the Fed has been dumping so much money into the market and buying so much, it's driving the prices higher. So the indicators for the movements of the stock market are the fundamental factors, which is what we did, the financials, and then the technical factors, which are more external, like inflation, taxes, competition, things like that, and then market sentiment, how people feel about the market, and the biases towards certain companies and industries. So now let's look at their ratios. So we need a little more information. Let's go back to the balance sheet. And then we'll get their current ratio, which is their current assets over their current liabilities. We also need their equity. That's also on the balance sheet. And they have a negative equity, which is not a good sign. I'll explain equity in a minute. And then let's get their EBIT, their earnings before interest and taxes, and that's operating income. So current assets of 800 million, that's cash, accounts receivable, and inventory. That's kind of like your liquid assets that you use to run your day-to-day business. And your current liabilities are your short-term liabilities, accounts payable and short-term debt. And those are the payables that are due within 12 months. So you want to have current assets above current liabilities. If you don't, then you have to take on more debt. And interesting to see that equity is negative. So equity is total assets minus total liabilities. So that means its liabilities are higher than its assets. And it appears that the way you come up with like retained earnings, which is in the equity section, it's a sum of all your previous net incomes. But if you pay out dividends, then you have to also reduce dividends from retained earnings. So we can see their net income has been positive every year. And I did look on their balance sheet. I'll show you. When you look in their equity section, the stockholders' equity, the retained earnings is negative. Everything else is positive. And the reason that is because retained earnings, by definition, is just a sum of previous net income. But if net income is positive, how could retained earnings be negative? And it looks like it's because dividends come out of retained earnings. So if a company pays dividends, they have to reduce it out of that part of the balance sheet. So they pay dividends. So every year they're reducing their retained earnings by the dividends paid. And it seems like they reduce it so much that it's now negative. So it seems like they're not cutting their dividend. So they're going to just have to, I guess, borrow more money if their net income doesn't provide enough liquidity to fund their dividends. So I don't see this as a problem. Normally, a negative equity is a problem, but since they only have 26% debt, they have a lot more room to borrow, and they're a pretty big company, so I'm not too concerned about this because they probably can fix this problem if they wanted to. So now that we have the ratios, we have the PE, which is the price of the stock over the earnings per share, and it's 18. I like to see under 15, but 18 is pretty good. The price over sales, it's the price of the stock over sales per share. I like to see under 2.2. This is 1.6, so it's right in the correct area. We can't get a price to book because they have negative equity, That's the price of stock over the book value per share or equity per share. Current ratio is current assets over current liabilities, and you want this to be at least 1, because if it's under 1, that means the company can't afford to run their day-to-day operations. They have to borrow money. This is 1.88, which is fine. It's in the right area. And they have negative ROE because they have negative equity. So we can't really get a read on their ROE. And we can compare it to 2 other companies because I've done DCF models for 2 other companies, PVF and VLO. And this is the company we're looking at, VVV, Valvoline. And I put the winners in the categories who had the best ratio. The PE, PBF has the best PE. They all have pretty good PE ratios. But that's why you should compare the PE to the companies in the same sector. Because if somebody who is new to investing and they're told, look at the PE ratio and then decide if you want to invest. And then they look at this company and say 18, okay, I'm investing because it's a good PE. And they compare it to like another company, I'm just making this up, Google has a 25 PE. And they say, well, 18 is better than 25, and Google's a great company, so I'm investing in Valvoline. But maybe the tech industry just has naturally higher PEs, and maybe 25 is the best of all the tech companies, and all the other companies have 50 PE. So you have to look at within your sector, because that will give you a better read on these ratios. Now the price of sales, they're all good. PBF has the best because it's 0.1. And then PBF has the best balance sheet. It's under 1. But 1.2 is really low as well. Current ratio, they're all in good shape in the current ratio, so they don't have to add debt just to fund their operations. ROE, they're all kind of weak in ROE. Debt. So it's nice to see that VVV has a little debt, or a lot lower than PBF. So that's the thing with ratios. You can distort ratios by taking on a lot of debt, because when you take on a lot of debt, it makes these other ratios look really good because debt isn't really factored in as much. So that's something you have to look at also, because if you say, oh wow, their PE is great, well, they just might have got a low PE because they took on all this extra debt, and it kind of makes this look more kind of inflated, a better number. So you got to look at the whole picture, and it just takes time to really figure that stuff out. And I added this feature, probability of default, and it's 0%, and I base it off of their interest coverage ratio, which is 5, which is great. That means the interest on a debt of $73 million, they could cover it 5 times off of their earnings. So that's great. As long as it has to be above 1, or else you could go into more debt or go into bankruptcy. But the probability of default is based on interest coverage ratio, percentage of debt, market cap, free cash flow, current ratio. Now I'm working on this formula to improve it as I do more deals, but it's 0% just because they don't have too much debt, and that's how you go into default, is you can't pay your debt. And if they couldn't pay their debt, they can just take on more debt to get through some difficult times. So they're not in imminent danger of default, at least in the next year or two, maybe in the future, 5-6 years possibly, but not anytime soon. So let me know in the comments what you think. Thanks for watching the video.